Well, joining us now is Tim Evans from Longleaf Trading Group. He joins us live from the CME in Chicago. Tim, hello to you. Certainly this idea of whatever it takes is set to be tested when it comes to this week's OPEC meeting. But from the commentary coming through, it would all suggest it's a bit of a done deal.
Hey, Natalie, nice to be with you today. Yeah, I mean, we're going to find out whatever it takes, what that actually means. I mean, the market, I think, by and large, given the rhetoric that was introduced to the market roughly about a week ago with the joint statement from the Russian and Saudi oil ministers. Yeah, I mean, I think the market, given the price action last week and what we've seen, coming to this very moment in time, is that, the market is pretty much priced in the expectation of that 6 to 9 month extension of the deal. So, I mean, it really leaves us in a very interesting spot here as we're preparing for the conclusion of that meeting later this week in terms of, what the market actually needs to get from that meeting in order to continue to on this upward trajectory that we've been on here over the last week. My view on that is whatever it's going to take is going to need to be a little more than that 9 months. I mean, I felt firmly in the fact that that production cut was going to need to be deeper in order to accelerate, the decline in global crude oil inventories. And some talk has been, circulating through the trading community that we could possibly, see a slightly deeper cut, but, nothing confirmed. So I think we're going to ultimately need to see that for the move to continue higher beyond $50, $51.
Well, just with that in mind, I did want to get your take on some of the price action that we could anticipate. Now, we have had analysts suggest that much of this extension is sort of already baked into the pie. What are we looking at in terms of longer-term pricing levels? Because we do seem to be hugging that $50, seeming to be very much a sweet spot, as it were.
Yeah, I think that's a good term. I mean, I think ultimately this $50 level, has served as the sweet spot. If we kind of consider the behavior of the market, we had that big move in November as the market was pricing in the potential impact of a production cut, and once the market began to lose faith in the effectiveness of it, then we had this sell-off, April, May. And the market, I think, found good balance. As we kind of washed out, all the week longs, the market rallied back here to about $50. So I think from a technical standpoint is really, as well as a fundamental standpoint, the market's at fair value. I mean, it seems to be good balance between consumers and producers here at the $50 level. I think an extension of this deal for another 6 to 9 months, at least at the current terms that the current deal is under, I think this $50 level should continue to kind of be that sticky point that the market oscillates around. Obviously, a deeper cut would change that equation, but without that, I think $50 is probably going to continue to be a relatively fair price moving forward in the short and intermediate term.
And we need to also consider this alongside the fact that some of the inventory numbers that we have coming out from the U.S. suggest that those increases are set to continue for the coming quarters.
That's right, and this really comes into my calculation in terms of will this market be able to find balance. I mean, if the market does respond well to where we see prices advance over $50, I mean, obviously that's going to provide the U.S. shale the opportunity to continue to ramp up production. I mean, just year over year, production is up about 10%, or 900,000 barrels to 9.3 million barrels a day. If prices are able to support, adding new rigs and continued exploration and continued production, and we just increase that by another 5%, I mean, that's another 500,000 barrels a day. So I mean, it really would invite, the U.S. shale to continue to be very aggressive, and I think those higher prices would really limit the effectiveness of this deal for another 6 to 9 months. So I think these deeper cuts are going to be needed.
Now, in terms of some of the corporate players within this story, naturally we are looking to that Aramco IPO, certainly, and how that will feed into Saudi Arabia's, particularly their economic future. But I just wanted to get your take on some of the players that you're keeping a close eye on, and who investors are looking to in order to trade this event.
Well, I mean, we have to kind of consider the makeup of the current market. I mean, hedge funds, managed money, you know, they were extremely long the market, you know, after that initial production cut was announced. You know, we've seen a pairing of that big long position, and it was stubbornly long. I mean, even as the market was selling off and evidence was really building up that, you know, this production cut wasn't having the intended effect it was meant to. However, that long position stayed very long, you know, until we kind of had that crash below the $45 level, and it cleansed the market to some degree. You know, and it has us back, I think, in a healthier condition here around that $50. But, you know, the funds are still very long. I mean, there's a couple 100,000 contracts still long, and I don't think there's any one particular firm or fund that really sticks out. I mean, it's an industry-wide position. You know, so I don't think if coming out of this meeting in Vienna, you know, the market doesn't get something that satisfies it in terms of continuing to maintain these long positions, this thing could get ugly pretty quick.
Absolutely. Well, we continue to watch and wait until Thursday, or in fact, for us here in Australia, it will be coming through on Friday. Tim, as always, thank you for your insights.
Have a nice day. Thanks, Natalie.